15 minutes remaining for question, and I would like to summarize a bit a few comments that have been written in the Q&A section with a concrete question, maybe to Ratna and leave you. As you both, I mean, let me illustrate that, but what is happening here in Switzerland. So the reaction here was really to make loans very cheap and available for everyone who needed some cash, right? And as you mentioned, Liviu, this is a ticking bomb, in a sense. Like at one point, these loans have to be repaid, and Ratna, you emphasize that these loans must be repaid. So how do we deal with the sequence or the timing of that? So there are some moratoriums in place that will progressively be lifted. The first payment or repayment will come in the next few months. So how do we deal with this situation concretely? What would be your recommendation? And then another question after also that I think is more global for Atif. A question: can we really achieve financial stability without mitigating extreme inequality? So is it, and actually can the central bank kind of justify the action on inequality by saying that it's detrimental to financial stability, that too much inequality is detrimental to financial stability? I don't know if any of you want to respond on this question, and take the floor now.
Here, I can start with this tough question, which relates to the severe trade-offs we see because of the COVID crisis, and everybody agrees that support measures are needed. But then the question arises, really, the question actually arises only because we don't know when this crisis will end. Because if they were short-lived, well-targeted, transparent, you can deal with that. So let me begin by saying that we supported at the IMF, large-scale moratoria and government guarantees because the shock was so huge. But at the same time, we are concerned quite a bit about the moral hazard problem that can arise if they direct very scarce resources to firms that may not be viable. And then, of course, this additional problem, the advanced economies have already high debt. The others, not as much, but they are also fiscally constrained. So there's quite, with government guarantees, you can have pretty large contingent liabilities and higher fiscal risks. So we have to worry about that also. So I'm just going to make one key point here. And the key point I want to make is that actually what is really important is that the banks can play a huge big role. How can the banks play a big role? The support, the banks and the authorities. So let me say both. And as we go along, these widespread measures should become much more targeted, as you know more about, where the needs are the highest. Now, turning to banks, the banks, they can play an important role by restructuring loans. They have the maximum information, which companies, firms are viable, were viable before, or not viable, and which ones have run into a problem only because of this crisis. So they should be adjusting the terms of the contract. They can help borrowers manage the temporary impact, and they can also minimize their own losses. So it should be in their own interest to change the terms of the loans for borrowers that are viable in the medium term in their assessment. Government can't do that. They don't have all the information on these. And because loan restructuring, they're really commercial decisions, they will themselves tend to be more targeted and therefore less negative implications than a blanket moratoria. So bottom line is, as the crisis evolves, broad moratoria should be phased out, while they should be more or loan restructurings by banks should play a much larger role. We do want the banks, on moral hazard to maintain some skin in the game. So let me stop.
Pierre, to answer your question on basically the exit strategy, and I'm coming from a country that cannot afford limitless fiscal deficits, and I think most countries actually cannot afford unless they issue reserve currency, and that's at least in the medium and long term. So I think for any measure, there are three very important dimensions: timing, dosage, and distribution. So I think, okay, it was a good timing now to take these measures, but gradually we need to restrict them, so to limit the dosage and to be more careful about the distribution of these measures. I don't have like a silver bullet or something, but it's I mean, I tend to disagree respectfully with with macroprudential policies being the culprit and bringing the recession in when you are in good times, because I think actually unsustainable credit is the one that brings recession. So macroprudential policies actually help, yes, limit the credit, but limit the credit to sustainable ones. So therefore, the potential recession which comes at some point will be less intense. And now it's a reverse. I mean, the flexibility cannot be again limitless. You need to have some flexibility, and of course, but you can target this flexibility towards those really in need. There are various support measures that can have or would be introduced by various central banks, and here the combination they must work together with government, because many of them can be based on fiscal incentives or some kind of guarantees or something which are not in the parohy of central bank. It is important for central bank to continue supervising banks closely, so that they would not, have a very loose standards. On the other hand, as I said, but you need to know who is really in need. We need distributional statistics. Once we have it, we can apply it. So it's not necessarily one policy for all. It can be more targeted. Could, for example, provide income, some kind of income support, or postpone credit repayment, or reduce debt payments for a while and extend the maturity of the loan, and without banks considering as non-performing loans and having to provision for it. So there are ways to do it, but you cannot do it all the time for all the loans. You can do it from now on for a limited period, for a limited number of loans.
Thank you very much. Atif, you want to go back on the question whether decreasing inequality could be a solution for more financial stability or something? It was suggested.
Well, I mean, absolutely. I mean, I think, as I said from the beginning, that is the core structural or the primitive problem that we are facing. That's why I started with the frog analogy, that, it is, look, sometimes pruning is the right approach. You just need to prune your garden, and the next time it will be fine. But sometimes the problem is much deeper, right? You really need to dig out the weeds and plant new plants and things of that sort. So I think what we are desperately, I would say, in need of structural changes, because the current financial system is, or the economic system rather, is not sustainable. I mean, that's the basic picture that comes out of analyzing the consequences of rising extreme inequality and savings glut of the rich that I emphasized. And it's in that sense that I say, look, the standard policies which are designed to tackle business cycle fluctuations, all of that intuition is exactly right, but it's not relevant. We are not facing a business cycle problem. We are facing a structural problem. There's a key distinction between the two. And that's all I'm emphasizing here, that more and more the business cycle variation is also being generated, in a sense, by that fundamental structural issue. Precisely, for example, that you need credit creation to keep the economy afloat, but that obviously has some side effects as well, that every once in a while you'll go overboard and things of that sort. But now at this point, you can't avoid not focusing on the structural problem, because even credit extension is no longer possible in the private sector, essentially, because everybody is levered to the hilt, and now the only place that can expand on the credit side is the public sector. And while I fully support deficit financing, because that's the only game in town, don't get me wrong, what I'm saying is that that's not going to solve the structural problem, and you're going to remain stuck at R star very low. Just on the side, I know we are running out of time, but Joseph asked some excellent questions on public versus private debt. And you're absolutely right. The two are not symmetric, Joseph. There is a difference, but it's a longer conversation. We're actually working on a new paper on precisely on that question. It really matters whether R that the governments can borrow at is less than G or not, and things of that nature. So it's a little bit more nuanced question, but I know we are short of time, and I want to give Joseph some time to respond as well.
Do you want to respond to the question or add comments?
No, I would only make one comment, which responds to all three of the people, and I think Atif basically alluded to right now. But there's a new paper by Jason Furman at PIE and Larry Summers, which looks at how you measure government debt burdens and correct measurement of government debt burdens. And they find that despite very high debt to GDP ratios in some countries, the true measure of debt burden is exceptionally low right now. And depending on the assumptions, it could actually be infinitely low. So that's the R minus G thing. But the government interest expense ability to carry this debt has never been stronger. But of course, as Liviu mentioned, you do need to issue this debt in your own currency, that you have your own central bank. If you're Greece and your central bank is in Frankfurt, you're in trouble. But for the rest of us, I don't know about Romania, you don't have to have reserve currency. You just need to have a central bank that has a mandate for price stability and issues its own currency. I'll stop there.
Thank you very much. So we're arriving to the end of this panel. A huge thank you to all of you. It was very inspiring, and it shows how the depth of the issue that debt, financial stability, and inequality raises. For the audience, I just want to remind you that this is a series of 3 panels on central banking and on central banks and inequality. The next 2 will address the issue of financial market infrastructure and inequality, and that's on Friday. You can register on the PIE website or on the CEP website. And the last panel will be next Monday on monetary policy and inequality. That being said, thank you very much for participating, and I hope you will have a good end of the day or for all of you. Thank you very much.
Thank you. It was a pleasure.
Thank you.